Welcome to the debate. Today, we are tackling one of the most critical and certainly one of the most contentious products in American retirement planning, the variable annuity. Now, this isn't some niche topic. We're talking about a market holding over, $2.2 trillion in assets, and sales just hit a record $385 billion in 2023. That clearly reflects an intense desire among retirees for, stable income.
It certainly shows something is driving sales, yes.
Right. So the central question that really emerges from all this material is pretty high stakes. Does the current market structure of variable annuities fundamentally serve the critical need for retirement security and guaranteed income? Or does it end up prioritizing the financial interests of the brokers and the insurance carriers who sell them?
And that's the crux of it.
From my perspective, I argue that VAs, variable annuities, they offer indispensable risk protection and guaranteed income that retirees absolutely need to navigate these increasingly volatile markets we're seeing.
I appreciate that focus on safety, I really do. But I just come at it from a completely different angle. That perceived stability you mention, I think it's often an illusion. The complexity, the embedded financial incentives for the intermediaries, they just negate the perceived value of these products. Too often, they lead investors straight into high-cost, frankly inferior contracts. And look, this is urgent, because we are talking about people's lifelong savings here. They deserve much better than a system that seems, rife with conflicts of interest.
We cannot just dismiss the core utility of risk transfer like that. Variable annuities are, I believe, essential tools for mitigating the two big existential threats retirees face: living too long, the longevity risk, and market volatility. VAs are structured with underlying investments, similar to mutual funds, but the crucial addition is that guaranteed income. Specifically, I'm talking about features like guaranteed lifetime withdrawal benefits, or GLWBs. These provide a contractually guaranteed income stream for life, irrespective of how the underlying market performs. That record $385 billion in sales, it proves that investors are actively seeking out the stability. When you have an indexed annuity promising, say, a 0% floor for index returns, that protection of principal is just paramount. For many, many retirees, that contractual guarantee fundamentally outweighs the associated fees.
That's an interesting point, though I would frame it quite differently. Those high expense ratios you mentioned, they aren't just a simple trade-off. They are, I think, the sign of a deep structural problem. When you actually examine the data, the mean expense ratio stands at, 2.24% of assets annually. Now, you combine that figure with the extreme broker commissions, which, let's be clear, can reach over 10% of the initial premium. It demonstrates precisely where the product's core benefits often lie, with the seller, not the buyer. Our analysis on this is pretty stark. VA sales are roughly 5 times more sensitive to the financial interest of brokers, meaning commissions, than they are to the interest of the investors themselves, like lower expenses. That's
a powerful indictment of the whole distribution model, isn't it?
I am just not convinced that this commission structure inherently implies misconduct or, automatically leads to poor client outcomes.
I'm sorry, but I just don't buy that the current distribution model is genuinely in the client's best interest when we look at the correlations. We see a direct link between the fees charged and the sales incentives paid out. Specifically, the data shows a 1 percentage point increase in expenses is associated with a 0.65 percentage point increase in the commission rates paid to the broker. Now, that isn't some coincidence. It means brokers are financially incentivized to push the products that extract more from the client's pocket. And the evidence on investor harm, it's quite clear. Products with higher expenses are associated with a significantly greater number of investor complaints and, worryingly, higher rates of broker misconduct records. The conflict of interest is structural, it's demonstrable.
Okay, I see why you think that. I do. But let me give you a different perspective on the complexity aspect. These higher commissions, maybe they're simply compensating brokers for the increased time and, frankly, the specialized knowledge required to model and explain these sophisticated risk transfer products. When you're trying to model a GLWB, that guaranteed lifetime income benefit. It involves calculating longevity risk, hedging market exposure over decades. I mean, that's not a simple mutual fund transaction, right? It requires specialized consultation. And the market signals seem to show that investors do value these guarantees, which is precisely why sales respond positively when these benefits are available.
I appreciate the complexity argument, but let's shift gears slightly and look at the actual paperwork, the structure. You're kind of glossing over a critical problem here. The incentives clearly favor illiquidity. Sales of VAs are demonstrably higher for products with longer lockup periods. Now, why would that be? Because the broker is prioritizing their own long-term trail commissions, potentially pushing clients into contracts that impose extremely steep surrender charges, sometimes hitting, 12% in the very first year? The broker seems to be prioritizing their long-term revenue stream over the client's, sometimes very necessary, need for liquidity.
But that constraint, the surrender charge, it's a cost of doing business, surely. It's not some conspiracy to harm the client. It is the cost required for the insurance carrier to successfully underwrite and hedge a multi-decade income promise. The client is paying for that risk transfer.
That's a compelling argument about risk transfer, I'll give you that. But have you really considered the fine print? I often say, the large print giveth and the small print taketh away. The marketing materials frequently create these inflated expectations. For instance, companies often promote hypothetical, back-tested returns for these complex indexes, like that JP Morgan Mosaic Index you might see. It was marketed with a hypothetical 6.30% annual return, but the index had only actually existed for 2 years when that marketing was assessed. The rest was just simulated performance. That creates expectations that are, fundamentally misleading for investors.
Hypothetical performance aside, the core value is still the protection. Critics, I find, consistently ignore the contractual safety nets that define the product's fundamental purpose. The insurance carrier assumes the risk here, and the contract explicitly defines a minimum guaranteed contract value, the MGCV. Now, this MGCV ensures the client receives at least 87.5% of the premium they deposited, growing at a guaranteed, albeit low, 1% each year, irrespective of market crashes. That is concrete, defined downside protection that, let's face it, traditional mutual funds simply cannot offer.
But you cannot just tout safety when the promise is immediately eroded by the very fees designed to pay for it. You claim no downside risk, but let's talk about those rider fees again. Those living benefit rider costs, they run between 95 and 115 basis points annually. Now, for our listeners, remember 100 basis points equals 1%. So you're paying nearly 1%, maybe more, every single year just for that guarantee. And that cost is deducted directly from the contract value.
Yes, risk transfer isn't free, of course that.
Exactly. But that deduction means if the underlying market index delivers a 0% return, which is the floor you just promised, the client is still losing 1% or more of their principal simply due to the fee deduction. So there is no longer a true 0% downside floor when the cost of the floor is being extracted directly from the principal. You are actually losing money just by purchasing the guarantee in that scenario.
But the MGCV still protects against the catastrophic loss scenario, the big market crash.
Perhaps from total wipeout, but even worse, the insurance carrier retains enormous contractual latitude to unilaterally revise key components later on. They can increase the annual spread charge significantly, sometimes up to 500 to nearly 700 basis points, depending on the index. The spread charge, again, for listeners, is essentially the cut the insurance company takes from any growth before they credit any returns to your account. This contractual right means the insurer has the power to change the rules later, drastically capping the client's potential upside, even if the index performs exceptionally well. That kind of flexibility for the insurer, it's massive regulatory latitude that traditional SEC-registered products would frankly never be granted.
Look, I fully acknowledge the need for the industry to improve transparency regarding these costs and, yes, these contractual revisions, but the underlying structure for managing risk in retirement, I still believe, remains sound. The fundamental disagreement here seems to be more over the distribution system, not the guarantee concept itself.
And we actually have empirical evidence about what happens when distribution is regulated properly.
Precisely. And that brings us to the Department of Labor fiduciary rule. The market's reaction back when it was proposed in 2016 provides, I think, clear empirical proof of the existing conflicts we've been discussing. When the DOL rule was issued, requiring brokers to act in their clients' best interests, what happened? The sales of high-expense variable annuities fell drastically. We're talking by 52% from the first quarter of 2015 to the first quarter of 2016. That figure alone is just staggering.
It is a significant market shift, no doubt, but let's be precise about the overall impact.
Well, the data shows that low-expense annuity sales remained relatively constant during that same period. But insurers immediately decreased the availability of those high-expense products because presumably they couldn't justify selling them under a fiduciary standard. Brokers immediately started steering clients away from the high-cost products once their incentives were better aligned with the client. Our estimates suggest this led to an increase in investors' average risk-adjusted returns by up to 92 basis points. To put that in simple terms, when brokers were forced, even temporarily, to act as fiduciaries, clients were essentially gaining nearly 1 full percentage point more in return annually simply by avoiding the highest cost products.
Okay, I would just caution against universal praise for that rule's impact, though. I come at it from a slightly different perspective. Total VA sales, let's remember, fell by 19% overall after the rule was issued. Now, that reduction in sales, it may indicate that the rule raised the fixed cost of providing complex financial advice. And that could potentially limit access to these valuable guaranteed products for all investors, especially maybe those with smaller accounts who really rely on brokers for guidance. We did see sales shift, partially anyway, over to fixed indexed annuities. So by creating this kind of regulatory moat, the DOL rule may have unintentionally hurt the very people it was trying to protect. Perhaps the middle-class investor who needed both the protection and the guidance the most.
We seem to support it here. We don't find strong evidence suggesting the rule disproportionately hurt smaller investors, actually. Sales sensitivity to minimum purchase thresholds didn't significantly change after the DOL rule proposal. What seems to have happened is the market simply shifted toward better quality, lower cost products for those investors who remained. It really proves that the conflict embedded in the distribution model was the key problem all along, not necessarily the complexity of the advice itself.
Look, despite the admitted complexity, and yes, the historical conflicts of interest inherent in the commission structure, variable annuities still offer unique combination: tax-deferred growth and essential guaranteed income streams. That's a tool few other products can truly match for long-term security. The real challenge, which I think the DOL experience illuminated, is ensuring we have a necessary regulatory environment to enforce transparency. But the product itself, I maintain, remains a critical tool for managing retirement risk and achieving, well, peace of mind.
The evidence for me is clear. The high commissions and the often opaque fees inherent in the VA market create a fundamental conflict where sales are driven primarily by broker profits. This too often places clients into inferior, high-cost products that are demonstrably associated with high complaint rates. The market's response to the DOL rule demonstrates quite powerfully that when broker incentives align with client best interests, investors benefit significantly through lower costs and higher risk-adjusted returns. The data strongly suggest that complexity is often just a convenient disguise for excessive expense.
The tension, then, between the undeniable value of guaranteed protection and the pervasive influence of distribution incentives in financial services, it remains a defining challenge for retirees today.
Indeed. And the material we discussed clearly suggests that regulation, particularly regulation that mandates a strong fiduciary standard, can significantly improve client outcomes when dealing with these complex, high-stakes retirement products.
And that is where our debate, hopefully, sharpens understanding for everyone listening.